So hello everybody. So I decided because of the weather and safety factors to keep people off the roads tonight. So I figured the best way to do this would be to make a video. And as I said, I'm going to make a video of chapter 6, which is very short. There are only 20 slides here. And it really only comes down to one big equation, the cash conversion cycle. And some of you have seen that already. And all it is the addition and subtraction of a bunch of ratios, okay? And then I'll send another video with a review, and we can discuss. I'll go over with you. I'll go over with you like a review for the next what's going to be on the midterm, okay? So let me just go over chapter 6 first. Again, it's only 20 slides, so it's very short. So we'll go over that. And basically, it's going to be managing cash flow and a discussion of the cash conversion cycle. All right, so we're going to simply do a simple cash budget. We're going to just construct a simple cash budget and determine the timing and amount of any cash needed. And we're going to describe how short-term projected statements of cash flows will relate to the cash budget. And of course, we need to know why short-term projected statements are important to a new startup or entrepreneur. And we're going to identify and describe the use of the conversion period ratios, which will lead us to the cash conversion cycle. And the cash conversion cycle is extremely important because basically it just shows how much money we spend on a product when we start to make it. So it's the period from cash going out to start making a product to the actual selling it and cash finally coming in the door. So there's two doors, right? One with cash going out and one with cash coming in. So we'll look at it that way, and we'll go over a couple slides. And what I want to do is get this so I can read the amount of time. So okay, so again, here's the life cycle approach to basically a new project. And you should all know by now all these stages, right? And this will be a good review, right? You should know the order of these stages in case on the midterm you're asked to put these in order. The development stage, the startup stage, survival stage, rapid growth stage, and early maturity stage, right? So a simple way to look at this is D, S, SS, right? Well, I guess it'll be a little confusing that way, but D and start and survive and rapid and early. Okay, so these are the phases of a new venture that's going to happen. Of course, you have to develop everything, and we're going to look at the cash with regards to the survival and the rapid growth stage. You'll notice that they're darker, so they're highlighted. So we're going to give some emphasis on these stages here. Okay. All right, so as we talked a little bit earlier about the development stage, right, we screen business ideas, and of course we have to prepare a business plan and get early financing from somewhere to start the business. So we have ideas going on in our head, and then of course we have the basic startup stage here, where we basically choose what kind of organization we're going to create, a limited liability corporation, and prepare initial financial statements, and obtain first round financing. Okay, so these are the two very early stages, and so that's important. So what I want to do is open this up a little. Give me 1 second. I'm trying to get this up. Okay, so so these are the two very beginning, and then here's the two we're going to basically look at, okay? And the survival stage is, we want to keep the company going, right? And this is where we really start monitoring our finances, and we start projecting cash needs, and we obtain first round financing, and we decide how things are going, and whether if the company's not going well, we may want to liquidate, or restructure it. Then if we get through this stage here, which, let me go back here, if we get through that stage, which is the survival stage right here, we now move on to the rapid growth stage where things are happening pretty quick, where we create and build value, right? And we start really building value into the company, and we look for more money if we need it, right? And of course, if things don't go well, we always have to have a plan B to get out of this project if we have to. And if we have to exit, or if we don't, if we go exit, we will sell or merge, right? With like some companies do, or we can go public and get stockholders and bring in more cash if we need more cash and things are going well. So this is a source of cash. It would be going public with stocks and bonds, right? We can do that. So those are the two important stages tonight. And of course, basically we have the early maturity stage where we start really ongoing, managing the company in an ongoing way, and we maintain and add value. And then we start adding more financing, again, if needed, seasoned financing from many different sources. Okay, so now we got to start making a short-term cash planning tool. How much sales do we expect based on what we've seen, right? And how much purchasing, and how much wages and commissions. If we have to pay our salaried employees, maybe we have to pay them commission based on sales or salary. Okay, so we got to worry about that too. So, and basically, and of course you have to make a cash budget, right? We've always got to worry about a cash budget here. So these become real important, and these are our short-term cash planning tools. Okay, and you'll notice their schedules, right? A sales, a purchase, right? What we've got to purchase, and as far as inventory, and if we have to pay wages and commission, we have to know how much ahead of time. Are we going to hire other people? All right, so here's an operating and cash budget. And you'll notice here, this is in your book. So let's go over this. And here's the sales forecast, right? So here's our sales forecast in thousands of dollars, right? 92,000. And basically, so this is all forecast. And you notice the word forecast, right? So we determine that 40% of this will be in credit and 60% in cash. And if you multiply this by 60%, you'll get this number. And if you multiply this by 40%, you'll get this number right here. And you can keep doing that all the way along here. And we're breaking down by a 40-60 ratio our credit and cash sales. If any of this you have any trouble with, just email me if you don't understand how to do these simple multiplications to get the breakdown in credit and cash here. All right, so this is the sales forecast, right? And here's the cash collection. All right, so here's the cash sales here. See the cash sales? That comes right down, right? And then the credit sales are a month later. Everyone see that? Here's the credit sales and for March, and they come over to here, okay? And we keep doing that. Here's the credit sales for April, and they come over to May, and the cash sales come down. Everybody see that? And the credit sales come over here, and the cash sales come down. So we always bring the cash sales down from that month, but we bring the credit sales are a month later, okay? And here's our total collection, which is the cash for that month plus the credit from last month. So all we're going to do is add these two numbers up, and we basically get the cash collection based on 1 month delay in the cash sales. So this is our sales schedule, and here's our purchase schedule now. And you can clearly see here, here's our ending inventory for each month, right? And here's what it cost us in cost of goods sold. So if we take these two numbers and we add them up, we find out we have a total needed of the total needed inventory, and we already had beginning inventory purchases from the previous month of 97,520. So if we subtract this from here, we basically get our purchases, which are basically 77,280. So we subtract off the inventory we had already, right? And basically all we did was add the cost of goods sold to whatever inventory we had left. And again, this is simple addition and subtraction, and we do that for each month here. Okay? So we just go through this. All right, so schedule, the next schedule, schedule 4, is purchasing what we got to buy, right? And 50% of last month's purchases. So 50% of this goes here, and 50% of this month's purchases, half of this goes here, right? So this is a month delay. This pulls down. And again, these two numbers, you just multiply by 0.5, and you'll get these right here. Okay? So, and we do the same thing for each month, 50%, 50%. So this pulls over to here, and then this pulls down, and then this pulls over to here, and then this pulls down, right? So last month, right, goes over. And here's our total disbursements of purchases. We just add up these two numbers, and we get this sum, okay? So for each month we add. So this is basically our purchasing schedule right here. Okay, so here's our wages and commission schedule. And here's all the fixed wages that are constant every month, right? And here's the commission. And that's 15% of our sales. So we would take our sales and multiply it by 0.15 and get these numbers here. If you have any questions on that, that should be in your book, let me know. And again, we just add these up, okay? And we get the total wages and commissions here. All right, so after we do that, we now take the disbursements of the wages and commissions. And again, it's 50% of last month plus 50% of this month. So again, we take half this, pull it down, half this, pull it down to here, half this, pull it down, half this, pull it down, right? So we take this 50% here, right? And then 50% goes there, and 50% goes there, and 50% goes there. So everything's delayed a month with regards to the 50% of last month's expenses, and then we take 50% of this month's expenses. All right. So that's basically it. And then again, we just add these up. Any questions, email me, and I'll make other videos for you. And that's really basically it for the schedules. All right, so here's the basically operating schedule and cash budget. So here's our beginning cash balance, and here's our cash receipts, and here's our disbursements, total disbursements, okay, the minimum cash balance needed, and again, and when we go through the simple math here, you'll find our cash balance is right here. So here's our cash balance, and this breaks it down item by item. This is from your book. So you can go through this and basically, if there's any questions, email me. So here's your beginning cash balance. Here's your basically cash receipts, that collections from customers. So that gives you your total cash balance here when you add these up. And then here's your disbursements. You're buying everything, right? Total disbursements. And basically here's the minimum you desire. So you need this amount of cash, and basically you figure out whether you got to borrow or you have a balance. So you notice here you have a balance, right? Here your new borrowing, and here's your loan balance, and then you make payments on the loan. All right, so Here's the we're going to talk now about, and the important thing in this chapter is the operating cycle. And this is simple. The cash comes in, you buy material, you make product, you make it finished, put it on the shelf, you sell it, and you wait for your cash to come in. And this is our circular operating ring cycle that goes on. And that goes around and around. All right, so we're going to talk about conversion period ratios. And basically, there's going to be 3 ratios that we got to worry about, and the 3 ratios will bring us our cash conversion cycle equation, which is very simple. So we got to discuss the conversion period ratio, and basically what that is the average time it takes in days to convert current assets, right, such as your accounts receivable and current liability accounts into cash, waiting for money to come in and paying your money out. So that's the ratios. And the operating cycle, and you should know the definition of this, right? And don't confuse this definition with that definition. The operating cycle is the time it takes to purchase, produce, and sell the venture's products, plus the time needed to collect receivables if the sales are on credit. Okay? So these have 2 very distinct definitions. Put these on your sheet. And lastly, we have the cash conversion cycle. This is the sum of the inventory to sales conversion period and the sales to cash conversion period, less the purchase to payment conversion period. A plus B minus C. And we're going to go over that right now. We're going to go over the 3 ratios. So the first one is the inventory to sales conversion period. And that's the average inventory divided by the cost of goods sold divided by 365. And I take these numbers off of my balance sheet here, right? And for 2 years, I take the average, so I divide it by 2. Here's my cost of goods sold. And basically, I get my inventory to sales conversion period is 112.9 days. So stuff sits on the shelf for 112.9 days before it's sold. I hope everyone's clear. So this is the first ratio we got to worry about. We're going to basically add up these, we're going to use these 3 ratios to get our cash conversion cycle. So I'll make that red. Right? So I'll make that red. And hold on. And basically we'll save that, right? And let me just save that. All right. So that's the first one, right? So again, I take this off the balance sheet and I take my cost of goods sold. All right. So if I have an inventory to sales ratio already, you can solve for the average inventories. So all they're basically doing is flinging this equation that I showed you around and solving for average inventories. I would take this number, if I was given a new one, multiply it by this right here, and get my average inventories, right? So inventories to sales conversion period times this right here, and that would give us our new average inventory right here. So we're just using that equation in 2 different ways. No big deal. All right, next ratio is the sales to conversion period, sales to cash conversion. So this is number 2, right, ratio number 2. And I take my average receivables off my balance sheet and take my net sales off of my income statement, which is right up on top, divide them out, right? You notice they're doing it, the average receivables are for 2 years here, right? Divided by 2. And here's my net sales and the sales to cash conversion period. So from the moment I make a sale to when the money comes in the door, it takes 57.1 days. Okay? That's my sales to cash conversion period. All right. And then we have the last one, which we're going to subtract. And this is number 3. And this is our purchase to payment conversion period. And how do I get this? I take my average account payables off of the right side of the balance sheet plus my average accrued liabilities, right? Divide that by my cost of goods sold off my income statement. And the numbers are here. You can, if you have any trouble finding these numbers, please let me know. So the moment, basically, where I make a purchase, now this is me making a purchase, to when I have to pay my vendor is going to take us almost 77 days. So this would be like me taking 77 days to pay my light bill or pay my bill. So if I buy something, I have about 80 days to pay it off. Okay? So those are the three ratios, the ones I have highlighted in red. Okay? And I now have the cash conversion cycle, which is equal to the three that we did. Inventory to sales conversion period that we just did, plus sales to cash conversion period, minus the purchase to payment conversion. And the three numbers we calculated are right here. And we end up with a cash conversion cycle of 93.2 days. So basically what this is saying is from the moment I buy get inventory in the door and make a product and sell it, and then get paid from the people who bought it, and then when I paid off my bills, the whole process takes 93.2 days. So I'm converting my product from inventory to when I pay my bills. It takes 93.2 days to get my cash in, and that's it. So this is the number, and it's all it is those three ratios. This one and plus this one added minus the purchase to payment period. All right, so if you have any questions, let me know. And here's now a table which shows all the ratios. Here, this is a summary of everything we did. Inventory to sales, sales to cash, payment, purchase to payment. And here was our number for 2016. This is the example we did. You'll notice it's 93.2 days. And here's the 93.2 days. So there's really not much math here tonight except for a couple ratios where we do simple addition and subtraction. All right, so that's basically it for this chapter. This was a pretty short chapter. And the only thing you have to worry about on this chapter is the math is simple. Put these ratios on your form, and basically knowing what knowing these titles. These should go on your sheet, right? What they are, so you don't confuse them. And you don't have to worry too much about this cash budget thing. There's not too much going on there, right? It's just simple. You won't see that on the midterm, so I wouldn't worry too much about it. And basically, again, you should know these stages here. If we, right, that the development stage is first, and then the startup stage, and the survival stage, and the rapid growth stage, and the early maturity stage is the last. So that's about it for this chapter. All right, so what I'm going to do is I'm going to make another video, and I'm going to go through all the other 5 chapters and do a review video, so you kind of can see what's important, and I'll kind of call out what's important, okay? Alrighty, so go over this, and later on you'll get another video from me. If you have any questions, email me.